If you think silver prices move because of simple supply and demand, stay with me for the next few minutes because what you're about to hear changes everything. What if the biggest silver price drops were not accidents, not market panic, but carefully timed moves between two of the most powerful exchanges on Earth, acting almost like they were reading from the same script? The CME in the United States and the Shanghai Exchange in China. Two different countries, two different systems, yet silver crashes at the exact same moments. That's not coincidence, that's coordination. Right now, before we go deeper, make sure you hit like and subscribe. This channel, Silver Uncovered, exists to expose what most financial media won't touch, and your support keeps these investigations coming. If you care about the real story behind silver, you're in the right place. Now let's slow this down and really understand what's happening. The CME controls the futures market, where paper silver trades in massive volumes. Shanghai controls one of the largest physical silver hubs in the world. One market is built on contracts and leverage. The other is built on real metal moving in and out of vaults. On paper, these markets are separate. In reality, they move together more often than they should, especially during moments of high tension in the silver market. Here's where it gets interesting. Time and time again, silver starts to build momentum in the US. Futures volume spikes. Retail interest grows. Headlines start appearing about shortages, inflation, or geopolitical stress. Just when silver looks ready to break higher, massive sell orders hit the CME during low liquidity hours. Prices drop fast, triggering stop losses. Confidence shakes, and at almost the same time, Shanghai opens with price pressure instead of strength. Ask yourself this: why would physical heavy markets not take advantage of lower prices by pushing demand higher? Why does price weakness appear synchronized instead of contested? Markets that are supposed to operate independently somehow reinforce the same downward move. This is where most analysts stop asking questions, but Silver Uncovered doesn't stop there. Let's talk mechanics, but in simple terms. Futures markets don't need real silver to move prices. They only need contracts. When enough paper silver is dumped in a short window, price collapses even if physical demand is strong. Shanghai, on the other hand, sets a reference for physical pricing in Asia. When both signals point down, the global price narrative is locked in. Now imagine you're a large institution with exposure on both sides. You know when liquidity is thin. You know when traders are over-leveraged. You know exactly how much pressure it takes to break technical levels. A sharp CME drop creates fear. Shanghai confirms it. Western media reports global weakness. Retail traders panic. Physical buyers hesitate. Mission accomplished. This pattern becomes even clearer when you look at timing. Many of the sharpest silver drops begin during US overnight sessions or early Asian hours. These are moments when retail participation is lowest and price can be moved with less resistance. That's not random behavior. That's strategy. Another thing most people miss is inventory signaling. When Shanghai inventories quietly rise during price drops, it suggests metal is being redirected, not disappearing. Low prices don't mean low demand. They often mean demand is being delayed, controlled, or funneled. This is where the idea of a crush makes sense. Crushing price isn't about destroying silver, it's about managing perception. As long as silver looks weak, it doesn't threaten currencies, bonds, or confidence in financial systems. A runaway silver price sends a message no central bank wants amplified. Think about it. Gold gets the headlines, but silver is the industrial metal tied to energy, electronics, solar, and military tech. A real silver price breakout would expose inflation far more honestly than CPI numbers ever could. That's why these synchronized moves matter. They suppress momentum. They break narratives before they spread. And they teach traders one thing over and over again: don't trust silver rallies. But here's the twist most people miss. These moves don't eliminate pressure. They compress it. Every artificial drop transfers silver from weak hands to strong hands, from leveraged traders to long-term holders, from paper promises to physical vaults. Over time, the system becomes more fragile, not more stable. Watch what happens after every major coordinated smash. Open interest resets, volatility cools, then quietly, physical premiums rise, delivery times extend, and the cycle repeats. This is not the behavior of a healthy market. It's the behavior of a managed one. Now, I want you to think critically. If CME and Shanghai were truly competing markets, price discrepancies would create arbitrage opportunities that push prices back to balance. But instead of opposing forces, we see reinforcing moves. That only happens when incentives align. That doesn't require secret phone calls or dramatic meetings. It only requires shared goals, stability, control, time. And time is the most important asset here. Every year silver stays suppressed is another year systems dependent on cheap metal survive. Another year confidence remains intact. Another year real price discovery is delayed, but delay is not prevention. As demand from energy transition, AI infrastructure, and defense continues to grow, physical silver availability tightens. Paper markets can signal anything they want, but eventually delivery matters. That's why you see growing interest in physical ownership, vault withdrawals, and long-term accumulation. Quiet moves, smart moves, and that's also why channels like Silver Uncovered are growing. People feel something is off, even if they can't explain it yet. Now here's where I want your input. Do you think these synchronized silver crashes are coincidence, or do you see a pattern forming? Drop your thoughts in the comments. I read them all, and the best ones often shape future videos. Before you go, make sure you share this video with anyone who follows silver, gold, or financial markets. Most people never question price action beyond headlines, and that's exactly why these strategies work. If you're still watching right now, you already know this isn't about hype. It's about understanding the game being played and positioning yourself ahead of the crowd. Silver doesn't need permission to move forever. It only needs one moment where control slips. And when that happens, people will look back at these coordinated moves and realize they weren't signs of weakness. They were signs of fear. This is Silver Uncovered. Stay sharp, stay curious, and I'll see you in the next one.